Welcome back to Global Value. In today's video, we will be performing a fundamental stock analysis of Tesla Inc., ticker symbol TSLA. Through our fundamental analysis, we're going to separate some of the signal from the noise concerning Tesla and come to an understanding of how to think about the company by taking a look at its financials. So at the time of recording this video, Tesla is trading for about $873 a share. Over the past year, they're up 39%, and going back to their IPO nearly 12 years ago, Tesla has returned an astonishing 55.5% compounded annualized return. So Tesla's at about $873 a share. This is in between its 52-week high of nearly $1,250 per share and its 52-week low of nearly $550 per share. Tesla is one of the largest companies in the world with a market cap of nearly $1 trillion at $987 billion. For some background about the business, Tesla was founded in 2003 and is based in Austin, Texas. Tesla is a vertically integrated, sustainable energy company that also aims to transition the world to electric mobility by making electric vehicles. The company sells solar panels and solar roofs for energy generation, plus batteries for stationary storage for residential and commercial properties, including utilities. Tesla has multiple vehicles in its fleet, which includes luxury and mid-size sedans and crossover SUVs. The company also plans to begin selling more affordable sedans and smaller SUVs, a light truck, a semi-truck, and a sports car. Global deliveries in 2021 were a little over 936,000 units. Let's get into the right value investing mindset by reminding ourselves of the 4 principles of value investing. Principle number 1, you're not buying and selling pieces of paper when you purchase a stock, and you're not buying and selling something that goes up or down on a chart. You're buying fractional ownership of a business, and you should think of it as if you're buying the whole business. Principle number 2, insist on a margin of safety. All companies are worth the sum of all the cash they'll generate from now until Judgment Day, discounted by some reasonable interest rate. If you can figure that out, then you should pay a price well below that. Principle number 3, Mr. Market. Your job is to make Mr. Market work for you and not the other way around. Mr. Market gives you quotes on businesses every few minutes. When he's providing you with quotes that are way too low, you should be buying from him. And when the quotes are way too high, you should be selling. And principle number 4, circle of competence. As investors, we don't deserve to earn money from anything that we can't understand. To ask the question, is this business within my circle of competence, is more or less to answer the question. We'll be performing an 8-pillar analysis as popularized by Everything Money and taking a look at Tesla's financials. Starting off with pillar number 1, we want Tesla's average 5-year PE to be below 22.5. Currently, their PE is about 129, and over the past 5 years, they've averaged a 151 PE. So this pillar is going to be an X right off the bat. Pillar number 2, we want their average 5-year return on capital to be above 9%. So while their return on capital has been increasing over this time frame, and as of the last year, it was 16%, averaged out, it only comes to 2.3%. So this pillar is also going to be an X. Pillar number 3, we want Tesla to have 5-year revenue growth, and boy do they. In 2017, they had revenues of just under $12 billion, and they grew this to just under $54 billion as of the end of 2021. They've nearly 5x their revenues. They've nearly 5x their revenues in the past 5 years. Pillar number 4, we want to see 5-year net income growth. This pillar is also going to be a check. Net income is represented by these columns in white here. In 2017, they had a net loss of about $2 billion, and they grew this to have net income of about $5.5 billion in 2021. So back-to-back checks on growth here. Pillar number 5, we don't want a business to be diluting existing shareholders. So we're looking for a decreasing shares outstanding. In 2017, they had 830 million shares outstanding, and this increased to 1.1 billion shares outstanding as of 2021. So this is going to be an X. And over 5 years, they've diluted shareholders nearly 40%. What this means is that as an owner of the business, you're ultimately entitled to a smaller percentage of its profits. This can be a silent killer for investors, especially if company insiders don't also hold a significant portion of their net wealth in the company shares. Pillar number 6, we want Tesla to have 5-year free cash flow growth. In 2017, they had negative free cash flow of nearly $4 billion, and they grew this to have positive free cash flow of nearly $3.5 billion in 2021. So pillar number 6 is going to be a check. Averaged out over these past 5 years, Tesla makes about $600 million of free cash flow each year. We're going to need that for pillars 7 and 8. Pillar number 7, we're looking at how the company utilizes leverage. We don't want to invest in over-leveraged businesses because these are the companies that have it the worst during financial downturns. We don't want to invest in over-leveraged businesses because these are the type of companies that can blow up and end up going bankrupt. Fortunately, that's not the case here. Tesla has negative net debt of about $8.8 billion. Net debt is long and short-term debt minus cash and cash equivalents. So having negative net debt means that the business has positive cash and cash equivalents on its balance sheet after paying off all of its debts. So after paying off all of its debt, Tesla would still have nearly $9 billion of cash and cash equivalents. So they have plenty of breathing room on their balance sheet. So that's an easy check for pillar number 7. Finally, the big pillar of them all, pillar number 8, we want Tesla's market cap to be below their 5-year average free cash flow multiplied by 20. This one's not even close. Tesla's market cap is about $1 trillion, and they produce about $500 million of free cash flow each year. Multiplying by 20, that only comes out to $10 billion. In fact, if we were to multiply Tesla's average 5-year PE of 151 times their free cash flow, that would still only come out to $75 billion. You would have to multiply that by 15 times to get to their market cap. So based on their free cash flow profile, Tesla's not even in the ballpark of having a margin of safety. So in summary, Tesla checks the box on 4 out of 8 pillars. They are wildly off on our valuation metrics. They earn less than average returns on capital, and they've been diluting shareholders to the tune of nearly 40%. However, the company is rapidly growing. They've nearly 5x their revenues over 5 years, and they've taken both their net income and their free cash flow from negative to positive. But still, their ability to create free cash flow is nowhere near their market cap. If you're interested in learning more about Tesla or keeping tabs on how the business is going to be impacted by Elon Musk dividing his time at Twitter, I recommend looking at some of Tesla's filings. You can find them on Ticker, very conveniently located, and you can dive into a 10K and read through their annual report. That's it for today's fundamental stock analysis of Tesla, ticker symbol TSLA. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Thanks for learning about Tesla, and have a great day.